Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about QINGDAO Port International Co. Limited annual report. QINGDAO Port International Co. Limited offers a wide range of businesses and services at the port of QINGDAO. The company provides container handling and supporting services, including loading and discharging containers, storage, transportation, and port management. In addition to container services, QINGDAO Port International also handles dry bulk cargo, such as metal ores, coal, grains, and general cargo. It offers liquid bulk handling and related services for crude oil and other liquid bulk cargoes. The company provides logistics and port value-added services, including storage, transportation, and agency services. The company's services extend to port auxiliary activities, including tugboat and barging, ocean shipping tallying, security, emergency, and handling services. It also offers shipping repair and agency, freight forwarding, engineering and construction, ship agency, property management, media, lightering, fuel storage, oil pipeline transportation, and check and inspection services. Furthermore, QINGDAO Port International engages in LNG operations, produces electricity and heat, and sells goods. The company manufactures port-related equipment and supplies products such as electricity, power, fuel, and other commodities. With a diverse range of businesses and services, QINGDAO Port International plays a significant role in the maritime industry at the port of QINGDAO. QINGDAO Port International Co., Limited, maintains a market capitalization of $50 billion, broadly in line with the industry peer group. QINGDAO Port International Co., Limited, trades at a higher price-to-earnings ratio of 8 times and a higher price-to-book ratio of 0.95 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced, even though it is trading at a higher price to value than it appears. We will need to evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The balance sheet appears very conservative, with liabilities representing only 25% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 4.97%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through an examination of various segments and entities within the industry. In terms of revenue growth, the dry bulk segment saw a significant increase of 4.52%, while the container general cargo segment experienced a substantial rise of 68.35%. The logistics handling and ancillary services segment also recorded a notable growth of 24.15%. On the other hand, certain segments and entities witnessed significant declines in revenue. For instance, undistributed amount offsetting intersegment transaction costs saw a decline of 7.46%, while the logistics segment experienced a decrease of 2.3%. Intersegment transaction costs also declined by 12.6%. At the entity level, some companies recorded substantial growth in revenue. Shandong Port Group and its subsidiaries, QINGDAO Port Engineering, Rizhao Port Container Development, and Shangang Luhai Zhengzhou all experienced significant increases in revenue. In contrast, COSCO Shipping Group and its subsidiaries, QDOT and QQCT, saw declines in sales. A closer examination of the common drivers of revenue growth or decline reveals that fluctuations in contracted but unfulfilled performance obligations, changes in revenue from main operations and other operations, variations in rental income, rendering of services, and others revenue all play a significant role. Additionally, variations in employee benefits, cost for outsourcing transportation, subcontract costs, depreciation of fixed assets, fuel and utility fees, consumption of other raw materials, labor outsourcing, repair expenses, amortization of intangible assets, consulting fee, depreciation of right-of-use assets, property management fees, depreciation of investment properties, auditor's fee, and others also contribute to revenue growth or decline. Net income experienced a decline of RMB 8.7 million in 2025 compared to the previous year. However, it rebounded with an increase of RMB 6 million in 2026 and a significant jump of RMB 68.8 billion in 2027. Profit margins also underwent changes during this period. The operating profit margin decreased from 37.7% in 2024 to 37.6% in 2025. While the net profit margin dropped from 30.3% to 29.9% in the same year. Despite these declines, most asset groups saw improvements in their profit margins, with some experiencing substantial increases. By 2027, the overall profit margin had improved significantly, rising from 34.6% to 40.3%. The company's financial performance is a testament to its ability to generate positive operating cash flow. This can be seen on page 108, where the net cash flows from operating activities are reported as RMB 5,548,596,729, indicating a significant inflow of funds into the business. Furthermore, this trend continues in subsequent years, with page 234 confirming that the company's net cash flows from operating activities remain positive at RMB 5,548,596,729. Additionally, on page 295, it is reported that the net cash from operating activities was a substantial RMB 227,437,217. The company's ability to generate positive operating cash flow is also evident in its increase in cash and cash equivalents. On page 322, it is stated that the operating cash flow is indeed positive, which has led to an increase in cash and cash equivalents of RMB 1,687,972,474 by the end of the year. In conclusion, the company's financial statements clearly indicate that it is generating positive operating cash flow, a key indicator of its financial health and stability. The recent performance of various segments within a company has been mixed. On the negative side, dry and break bulk cargo handling and ancillary services have seen a significant decline of 29.1%, while liquid bulk cargo handling and ancillary services have decreased by 22.8%. Additionally, disposal of investments has experienced a substantial drop of 70.1%. In contrast, some segments have shown improvement. Container handling and ancillary services have increased by 32.1%, with port ancillary services also experiencing a modest growth of 3%. Furthermore, sales of goods or rendering services have seen a rise of 7.2%, and refund of taxes and surcharges has surged by an impressive 62.3%. These positive trends suggest that certain areas within the company are performing well despite overall mixed results. Management is optimistic about the company's outlook, citing a strong distributable reserves that will support a proposed dividend of RMB 12,242 million at the 2025 AGM. The company expects to see significant growth in revenue, with an increase of 18.8% to RMB 18.8 billion driven by expansion in the logistics segment. In terms of investments, management is committed to long-term equity investments and associates, which will likely drive future growth. 2 major investment projects have been authorized, totaling RMB 15,711,667,100, indicating a focus on strategic development. While litigation may pose some risk, management believes it will not have a material adverse impact on operations. The company's financial performance is also expected to be influenced by the value of equity instrument investments, which could result in an increase or decrease of RMB 25,804,000 in net profit if prices fluctuate by 10%. Overall, management's comments suggest a positive outlook for the company, with a focus on growth and strategic development. The company has a history of paying dividends to its shareholders. Multiple pages within the document confirm this fact, with explicit statements and detailed information regarding the dividend payouts. The amounts paid out in both 2024 and 2025 are listed, totaling RMB 610 million in 2025 and RMB billion 636 million 35,710 in 2024. This demonstrates a consistent commitment to returning value to shareholders through dividends. In contrast, there is no clear information on share buybacks within the provided document. The focus remains firmly on dividend payments, with no mention or indication of any share repurchase activities by the company. There are concerns about inventory buildup and supply chain disruption in certain companies. Inventory levels have fluctuated significantly for some firms, with QINGDAO Port Group's inventory increasing by RMB 7,664,052 and Luhai Equipment Group, QINGDAO's inventory decreasing by RMB 3,118,005. Some companies have also shown signs of potential inventory buildup issues, such as significant increases in prepayments and other non-current assets from related parties. For instance, Luhai Equipment Group QINGDAO saw RMB 103.55 million increase in these assets. Supply chain disruption concerns are also present, with some firms experiencing significant increases in contract liabilities. COSCO Shipping Lines and OOCL Containers are examples of companies that may be facing supply chain issues due to these increased liabilities. While there are instances of inventory buildup and supply chain disruption, further analysis is needed to fully understand the extent of these problems across all companies. That concludes the financial summary for QINGDAO Port International Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.